Hey guys, remember in our last video we talked about the long call. Today we're going to talk about the bull call spread. The long call is if you think it's going to go to the moon. The bull call spread is a little bit safer strategy where you think it may go up, but maybe not to the moon. It's also a cheaper way to get into the stock. So with that, let's jump in. All right, you remember how last time I showed you the P&L diagram of a long call? You had the cost of the option, and then you had this profit diagram here that showed that the profit was theoretically unlimited. A bull call spread caps the profit but reduces the cost. Let's go back to the example. Remember, it was $5 for a $100 call option. We're going to reduce that because we're going to sell a call up here. So we're going to buy this call, and rather than just buy it and hold it and then the profit goes through the roof, we're going to buy it but simultaneously sell a call here. So in our last example, we had a $100 call and we had a $5 call option. That's what the price was. So that meant we had to get to 105 in order to break even. Now what we're going to do is we're going to sell a call potentially out here, depending on how bullish we are. Maybe we're not bullish, but we're moderately bullish. And we'll sell a call, let's say at 115. And we'll sell that for $1.80. So this one's going to cost us $5. For this one is going to cost $1.80. And since we're selling it, we're going to get a $1.80 credit. But what that does is it caps it to this point here. That means I can't make any more money if the stock goes above 115. That's my limit. I can't make any more than that. If it goes to 130, I don't get to participate in all that upside. I only get to go from 105 to 115. That's all the profit that I get to participate in. But the downside is I get it cheaper because I paid $5 here, sold that, so it's $1.80. I get to participate for $320. So $320 is all I'm going to lose. Again, in our last example, remember, if we went all the way down to $50, the most we're going to lose. And our new example is $320 because I bought it for $5, sold it for $320. So let's take a look at the two side by side. So before we talked about just buying the 175, and I'm going to use this as EA. We'll get to that in a second. The example is going to be EA on the next screen. But the long call is $500 and the max loss was $500. Now I'm going to do the same thing on EA, 175 and 185. So I'm going to give myself a $10 spread, but look, it's only going to cost me $320. My max loss is $320. The most I can make is simply the spread, the difference in the spread. So 175 and 185. So that's 10 minus the $320 that I'm going to pay here. So if it's, again, remember we multiply by 100, so it's actually 1,000 is my max profit minus the debit paid, which is $320. Okay, so now my max profit is $680. So the benefit is I spend $320. That's my benefit because that's all I'm putting up front. That's my risk to hold these same 100 shares. I don't get to participate in any of the upside. And in so doing, by paying a little bit cheaper, I'm going to cap my profit on this side. Again, only making $680. $680 on a $320 investment. That's a pretty good deal. I'll take that all day long. That's how that works. So now let's go talk about EA. This is the example. Remember, September 1st, we're at 175. So if I'm going to do this way out here, this is 170, 175, 180, 185, 190. And I'm bullish, but I'm not crazy bullish. So I would buy the 175 contract here, buy this 175 contract, and I'm going to sell this 185 contract. So this guy here is selling for $5 or 500, and this one is selling for 180. So I'm going to offset my cost. This now becomes 320. That's my total debit paid. So even if the stock tanks and goes way down here, the most I'm going to lose is 320. if it's just the debit paid. If the stock rises, and by October, whatever the date was in October, and I hit this moment here, the most I'm going to make is 680. We just walked through that just a minute ago. If it goes all the way up here, doesn't matter. The most I'm going to make is 680 because I sold this guy. So I bought the call, and now I've got to sell the shares because I'm selling the call. It's another part of the contract. I'm selling the call, and I've got to sell my shares then at 185. Again, only get to participate in this range here. That's all I get to participate in. That profit diagram looks like this. We looked at that a second ago. Cost, max profit. All right. So if you're super bullish, go out and buy a call option and don't sell a cap. But if you are moderately bullish, sell a cap, lower your cost, and there might be a chance that the stock doesn't even get up there. If the stock only gets to 180, guess what? That's $5 because you got 175 minus, or 180 is where you got to. So 180 minus the 175 is 500, minus the debit paid is 320. So minus the debit paid on that one, you get to make 180 bucks. In the previous example, if we just bought the long call for 5, if you go from 175 to 180, that's your break even. So it lowers your break even. That's the benefit of the bull call spread. Lowers your break even, reduces your risk even further. Again, it caps the upside. All right, so just to bring this home a little bit, here is the option chain we looked at before. We're on the call side of the option chain. We're looking at Electronic Arts. Here's our 175 strike, selling for $5. We're going to go up to 185 and sell it for $1.80. I'm going to participate in this range here. Now, the odds of that happening, remember before we looked at delta? So I have a 22% chance that the stock will expire at or above 185. So 22% chance. That is typically a delta that you would want to play, is 20 to 30, a 20 to 30% range. You think it's going to go up, there's a 22% chance that it'll go above 185. So why not sell a call at this point, or maybe even $1.90? You can sell it for $1.05, and there's only 15% chance that it'll get there. And you can reduce your cost, but maybe not as much, but you give yourself a little bit more wiggle room, because now you're going to be 190 minus 175 is $1,500 minus the debit paid, which in this case, if you did 5 and 105, it'd be 395. So you'd be looking at $1,105 if you did a 190. And then keep going up. Look, the odds of that going up there. So it gets to the point where also, if I go up here where there's only a 5% chance of getting to 200, I'm only going to be able to sell that for around, it looks like 55, maybe $40. So it becomes not even worth it to sell a call at that point. But a 20 to 30 delta is a decent range to look at. Just to wrap it up, bull call options or bull call spread, moderately bullish. You hold the stock for a lower price, but the profit is capped. It does have a time component, so it does expire. If the price never reaches on expiration date, if it never reaches those price points that we picked, like the 175, 180, 185, if it never reaches that, then the option is going to expire worthless, and you can lose $3.20, $320, or 100% of your investment. So that is one of the risks of call options. Even if the price stays exactly at $170, like the EA is today, if it stays there up by the mid-October range that we looked at, you're going to lose the entire cost of the premium. It has to go above that price. It has to go above 175 to start with, and then whatever the debit is, that would be your break even. So in this example, where it was $3.20, it would have to go to 178.20 in order to break even. So just keep those things in mind. It's a great strategy. Actually, most of the time I trade spreads because it does allow me to get into a little bit of position even cheaper. And a lot of times stocks don't go to the moon. Keep that in mind as well. All right. So if you like this video, please hit the subscribe button. This is the second video. I will be doing more of these. Each one are going to get a little bit more and more complicated. So again, subscribe. Let me know if you like this, and happy trading.